RBI has released operational guidelines for digital lending in a bid to protect borrowers from growing frauds and unethical recovery practices. As per the RBI, regulated entities cannot store borrowers' data except for some basic minimal information. Data cannot be collected without borrowers' explicit consent. New rules to be applicable to the existing customers availing fresh loans and to new customers effective immediately. However, in order to ensure a smooth transition, regulated entities have been given time till 30th of November 2022 to conform to new guidelines in letter and spirit. Ritu Singh gets us more.
The Reserve Bank of India has released the much-awaited digital lending guidelines based on the recommendations of the working group, and this has been done in a bid to protect borrowers from growing frauds and unethical recovery practices that have been seen in this space. And these rules very clearly say that any loan disbursement and repayment has to be done directly into the bank account of the borrower and not any third party or lending service provider. Any data of the borrower which is stored by these third parties or loan service providers can only be very minimal, only for the purpose of operations, and no data of the borrower can be used or saved without the explicit consent of the borrower. RBI has also mandated a full disclosure of the all-inclusive cost of these digital loans, which has to be presented to the borrower in a key fact statement at the time of sanctioning the loan. No automatic increase in limits, in credit limits can happen, which has often been the case, which is also now something that RBI has clamped down on. Data collected by digital lending apps will have to be need-based and also have clear audit trails. Importantly, all of these loans, irrespective of the nature and tenor, will have to be disclosed by the regulated entity to the credit information companies as per the existing rules. Largely, this ends any sort of uncertainty around the digital lending guidelines. It also, it could increase the cost of compliance for some of the fintechs, but overall, it is seen as a positive step, in protection of the borrowers. Of course, we'll have to see how the industry reacts to these.
All right. Thank you very much, Ritu Singh, for joining us.